I also think that the messaging that the Fed offers this week is also going to be critical. If we have a 25 basis point cut, but the Fed also signals that it is on the way to cutting more and is still open to a 50 basis point cut, say in November, I don't think the market reaction would be that adverse. That is so pro-dollar. In fact, we could see a bit of a rally in the dollar on a 25 basis point cut. But when the market starts to read between the lines and look at the Fed's messaging, the dollar may weaken a bit again.
Right. So where is that inflection point for the dollar in terms of meaningful weakness? And a lot of that is predicated on where lies neutral. How much visibility and how much information will we get in terms of how many more cumulative rate cuts are down the pike?
I don't think we're going to get much information. I think the Fed is going to continue to, proclaim that it's data dependent to some extent. I think to the extent that they do not rule out a 50 basis point cut at some point in the next one or two meetings, the market will simply assume that this is possible. But I should say that there really isn't an equilibrium for the dollar because a lot of this depends on the direction, not just of monetary policy, but on fiscal policy and other policies, including immigration policy and tariff policy, are all relevant here. And when I say there's no equilibrium, it's in part because we simply don't know who's going to win this election and where policy will evolve post 2024. I think it's going to be critical to see what happens with taxes. It's going to be critical to see what happens with immigration. It's going to be critical to see what happens with tariffs, because all of these things can influence the level of inflation in the U.S. and by virtue of that, influence Fed policy. And by virtue of that, influence where the dollar goes. So if you believe, for example, that we're going to have a very expansive fiscal policy, a very restrictive immigration policy, a very high tariff policy, you could say that this is going to be pro-dollar, although in 2025, once we see who wins and what direction policy takes. And the opposite would be true, too. If we see an unexpansive fiscal policy, an unrestricted immigration, fewer tariffs, well, then you can make a case that the dollar conceivably could weaken because that would be less inflationary and the Fed would not be justified in pursuing a very loose policy. A hawkish policy. So again, a lot of this depends on where politics goes, and I would venture that it's very difficult to ascertain where the equilibrium is because of that.
So Thierry, you're talking about outcomes without actually mentioning Trump or Harris, right? But the other thing is, regardless of who wins, right? Deficit's not going away. The debt's not going away. It's still going to continue to be a problem, which argues for continued record issuance, which argues for support for yields and therefore the dollar, no?
Yes. If the U.S. were the only country issuing bonds, I'd have to agree with you. If the U.S. were the only country with a large deficit, I'd have to agree with you. Unfortunately, we live in a world right now where deficits are a problem around the world. They're a problem in Europe. They're a problem in Japan. Certainly the debt is. There's certainly a problem in many emerging markets post the spending that we saw after COVID. So there's going to be, if you ask, is there a need for fiscal restraint? I would say yes, but it's not just in the U.S. It's around the world that we need to see that restraint, if we want to ensure that there's no accident. But let me say this, to the extent that there is high debt around the world, it does tend to make traders, investors gravitate still towards those haven currencies, towards the yen, towards the dollar. So if this is a global problem, I don't see it necessarily implying either higher yields necessarily, but certainly not a higher dollar. I'm sorry. If it is a global problem, it could become a strong dollar problem, but not necessarily a high yield problem for the U.S.